Welcome to the Deep Dive. Today we're tackling, well, a really interesting accounting puzzle. Imagine this. A company's most valuable asset, maybe some core software IP, is actually understated on the balance sheet, systematically.
Right.
And not because of any funny business, no fraud, just standard accounting rules being followed.
Exactly. Which sounds counterintuitive.
It really does, and it creates this huge blind spot, doesn't it? Especially if you, the listener, are focused on metrics like book value.
Absolutely.
So our mission today is to dive into the source material on this. We want to figure out how government R&D tax incentives,
Yeah.
those grants for tech and software development,
Yeah.
how they actually distort the reported value of intellectual property.
Yeah. And it's fascinating because the incentive itself, the grants, I mean, that's a good thing, right? It's cash, it encourages innovation.
Sure.
But it's the accounting for it that obscures the real picture. So our goal really is to understand that gap, the gap between the, let's call it accounting reality and the actual economic reality. What did it truly cost? What's it really worth?
Okay, let's get into the mechanics then. Walk me through how these rules actually mandate deducting the grant. Because like you said, it feels backwards.
It does.
So say a company spends $1 million developing some software. That's labor, servers, the whole deal.
Right.
Normally, you'd capitalize that $1 million as an intangible asset on the balance sheet. Seems straightforward.
That's your gross investment, $1 million. But here's the twist, and this is key under certain standards, particularly IAS 20 within IFRS, which is used, pretty much globally outside the U.S.
Okay, IS 20.
If that company gets a government grant for that R&D, say $300,000 back for that $1 million project,
Yeah.
IFRS often requires them to deduct that grant directly from the asset's cost.
Deduct it. So
Yeah.
the asset on the balance sheet doesn't show up as $1 million anymore.
Nope. It shows up as $700,000.
Wow. Okay, hold on. Why? Why would the rule want to make the asset look cheaper than it actually costs to build?
It's all about the net investment perspective. The accounting standard basically says, well, the company only ended up being out of pocket $700,000 because the government chipped in $300,000.
Okay. So it's focusing on the company's cash outlay.
Precisely. That's the accounting reality.
Hmm.
A $700,000 asset. But, and this is the critical part, the economic reality is totally different.
Right. Because the software didn't magically require less work.
Exactly. It still took $1 million worth of developer time, resources, everything. If they had to build it again tomorrow, it would cost $1 million. That $1 million figure, the true gross cost. You often only find it buried deep in the footnotes of the financial statement.
Yes, that's huge. If you're an investor relying on reported book value, you're looking at a number that's just fundamentally understated. And I guess this distortion must ripple through everything else.
Oh, absolutely. It creates, well, at least 3 major analytical blind spots for you as an investor, especially when you're trying to compare companies.
Okay, what are they?
First, the most obvious one, understated asset values, book value per share, price to book ratios. They're all based on an artificially low number. You're missing that hidden chunk of IP value.
Right. And if the asset base itself is lower, that must mess up efficiency metrics too, like ROA.
Spot on. That's the second blind spot. Distorted financial metrics, your return on assets, your asset turnover, anything with assets in the denominator, it looks artificially high.
Because the A is smaller than it should be.
Exactly. The company looks more efficient at using its capital than it maybe really is compared to if it had funded the whole thing itself. And that leads directly to the third issue, competitive analysis challenges. Imagine you've got 2 companies, right? Both building identical, say, $10 million tech platforms,
Yeah.
but one's in, say, France, getting big R&D credits, and the other's somewhere with no subsidies. The French company, purely because of this accounting rule, is going to look like it has much better asset efficiency.
Even if management skill and the tech itself are identical.
Identical. It's purely an accounting artifact driven by the subsidy.
Now, you mentioned this analysis often starts with Australia. And our sources highlight that's because Australia has, well, one of the most generous R&D incentive schemes out there, right?
Yeah.
Up to 43.5% tax offset.
That's correct. It's very significant.
And crucially, I think you mentioned it's refundable. Can you just quickly explain for listeners why refundable is such a key feature here? What does that mean in practice?
Yeah, refundable is a big deal. It means even if a company is loss-making, even if they owe zero corporate tax.
Right.
The government literally writes them a check for that 43.5%, or whatever the eligible rate is, of their R&D spend. It's actual cash back in their pocket, not just a reduction of future tax bills.
So it's a direct cash subsidy.
Exactly, which is why it has such a potent effect when combined with that IFRS rule of deducting the grant from the asset cost. It can slash the net cost shown on the balance sheet hugely.
Let's make this concrete. Our source material brought up a specific example, PharmX, ticker PHX.AX, on the Australian exchange.
Yes, that was a good case study.
It showed that in just one 6-month period, PharmX spent AUD 1.45 million gross on capitalized software development.
Right, the full cost.
But because of those refundable incentives, they got AUD 0.62 million back from the government.
Mm-hmm.
So the net increase that actually hit their balance sheet, only AUD 0.83 million.
Less than 60% of the actual spend.
Exactly. And the impact, according to the source, was about an 8% reduction in the total carrying value of all their intangible assets just from that period's incentive. All hidden unless you dig.
Yeah, and all perfectly legitimate under the accounting rules. That PharmX example really proves the point. There's a real measurable undershoot in book value happening.
Okay, so we've established the what and the how. But the crucial part for investors is, so what? How do you actually use this information? What are the investment implications?
Right, because it's not automatically just good or bad. You have to weigh the pros and cons. There's a bull case and a bear case, essentially.
Okay, give me the bull case first. Why might this hidden value be attractive?
Well, the bull case is pretty straightforward. First, you've got genuine, unrecognized IP value. The asset is just worth more economically than the books say. That could mean a hidden margin of safety.
Right. The replacement cost is higher.
Exactly. And second, there are real cash flow benefits. The government is effectively co-funding your R&D. That lowers your net investment needs, which should boost your free cash flow generation, all else being equal.
Okay, that sounds pretty good, but there's always a but, right? This raises an important question. What's the bear case? What's the catch?
The bear case, really centers on incentive dependency. That's the big one. Meaning, what if a company builds its whole R&D budget and strategy, assuming, say, a 40% rebate is always going to be there?
Yeah.
If that government program changes, gets cut back, or maybe the company structure changes and they're no longer eligible, suddenly their cost of innovation skyrockets overnight. It's a major risk concentration, relying heavily on that government funding.
Relying too much on one big customer.
Very similar concept. And there's another angle, too, maybe a bit more subtle. Does the availability of these big incentives maybe distort R&D decisions?
How so?
Well, does it encourage companies to pursue R&D for R&D's sake, just to maximize the tax refund, rather than focusing only on projects with genuinely high expected returns?
Quality question.
Exactly. You could argue a company funding its R&D purely from its own strong operating cash flow might be signaling more conviction about those projects' ultimate value.
Okay, so how do you, as an investor, balance these two sides? The hidden value versus the dependency risk?
You need a framework. You need to track specific things beyond just the headline numbers. I'd suggest 3 key things.
Go on.
First, always try to find the gross development spend and compare it to the net capitalized amount that actually hits the balance sheet. See how big that gap is?
Okay, quantify the distortion.
Second, calculate what you might call an R&D incentive dependency ratio. Basically, what percentage of their total R&D spend is being covered by these incentives. That gives you a measure of that concentration risk we talked about.
Right, like a funding concentration metric. Makes sense.
And third, try to calculate an adjusted ROA using the gross development cost in your asset base. That lets you compare efficiency more fairly across companies, whether they get subsidies or not, apples to apples.
That sounds useful, but potentially like a lot of digging in the financial reports. For listeners wanting to actually do this, where specifically should they be looking? Where's this data hidden?
It is digging, definitely, but that's often where the value lies, right? You need to go straight to the notes to the financial statements.
Okay.
Look for 2 key notes. First, the note on intangible assets. That should, ideally, show the gross carrying amount of capitalized software or R&D before any grant deductions.
Right, the starting point.
Then find the note on government grants. This is crucial. It should disclose the amount of incentive received and, importantly, the accounting method used. Are they deducting it from the asset or maybe recognizing it as income over time? The method matters.
And I suppose transparency here is key.
Absolutely. If a company clearly discloses the gross spend, the grant amount, and the net impact, that's a green flag. It shows they understand the economics. If they bury the details or make it hard to reconcile, that's definitely a red flag.
Okay, this is fascinating. Now, let's broaden the lens because you mentioned IFRS and IAS 20. This isn't just an Australian thing. How does this accounting distortion play out globally? Does it vary much?
Oh, it varies massively. And this is where comparing companies across borders gets really tricky. The distortion depends hugely on both the generosity of the local incentive and the accounting standards applied.
So where do we see the biggest distortions, like Australia?
Well, as we discussed, systems with generous refundable cash grants combined with IFRS rules that deduct the grant from the asset cost create the biggest understatement of IP value. Australia is a prime example. France is another big one.
Oh, yeah.
Yeah, France has its Crédit d'impôt recherche, CIR, which can be quite generous, something like a 36% implied subsidy for smaller companies, and parts of it can be refundable too, so you'd expect similar understatement issues there.
Okay. But what about the U.S.? They mostly use GAAP, not IFRS. How does it work there? Is it cleaner?
It's different, not necessarily cleaner, just a different analytical challenge.
Yeah.
The U.S. has had some back and forth on R&D tax treatment. For a while, companies had to amortize R&D expenses for tax purposes over 5 years.
Right, that's controversial.
Very. But legislation restored the ability for companies to immediately deduct 100% of their R&D expenses for tax purposes starting mid-2025.
Okay, so immediate tax deduction.
Yeah.
But for financial reporting under GAAP, they still capitalize a lot of that R&D, right?
Often, yes, especially software development costs under GAAP rules. And that mismatch expensing immediately for tax, capitalizing for the books, creates a different kind of balance sheet item, a deferred tax asset or DTA.
Okay, DTA. Briefly, for listeners maybe less familiar, what exactly is that DTA representing and what's the risk?
A DTA is basically like prepaid taxes. The company got a tax break now by expensing R&D, but the accounting expense on the income statement comes later as the asset is amortized. So the DTA represents the future tax savings the company expects because its taxable income will be lower than its book income down the road.
Good.
The risk, or the Q judgment call, is realizability. That DTA is only valuable if the company is actually going to be profitable enough in the future to use those tax deductions. If future profits are uncertain, that DTA might have to be written down.
So analyzing a U.S. tech company shifts the focus.
Mm-hmm.
Instead of digging for the gross asset value hidden by a grant.
Exactly. You're scrutinizing the size and, more importantly, the quality and likelihood of realizing that deferred tax asset on the balance sheet. It's a different kind of potential overstatement or risk.
Fascinating. So we have the IFRS grant deduction model, the U.S. GAPTA model.
Mm-hmm.
Are there other major systems we should be aware of?
Yeah, there are variations. Germany, for instance, introduced an R&D tax allowance, but it's more targeted like a 25% cash refund, but mainly only on eligible personnel costs, not all R&D. So the scope is narrower.
Okay.
And then you have places like Denmark or other Nordic countries that sometimes use a super deduction.
Super deduction.
Yeah, it means they might let companies deduct, say, 130% of their R&D cost for tax purposes. But crucially, this only benefits companies that are already profitable and have tax liability to offset. It's not typically refundable cash.
So less direct balance sheet distortion from that kind of system.
Generally, yes. It primarily impacts the effective tax rate for profitable companies rather than directly suppressing the reported asset value in the same way a deducted grant does under IFRS.
Okay, the big takeaway here seems to be that cross-border comparisons of tech companies based purely on reported balance sheets are incredibly dangerous.
Treacherous is a good word for it. An Australian or French company's reported IP value is likely to be systematically lower than a comparable Nordic or maybe even a U.S. GAAP company's, purely due to these accounting and tax differences. You absolutely cannot compare their book values or ROA directly without making significant adjustments.
Right, you're just not comparing apples with apples otherwise.
Not even close.
So let's try to synthesize this. R&D incentives globally seem like a good thing for driving innovation, right?
Oh, undoubtedly. From an economic policy perspective, they generally achieve their aim of encouraging more R&D investment than would happen otherwise. They're a net positive.
Well,
But for you, the investor, they create this accounting maze. If you don't understand how these grants interact with specific accounting standards like IFRS versus GAAP and the distortions they create, you're going to have major blind spots in how you value the company, how you assess its efficiency, how you judge its risk profile, and definitely how you compare it to its peers.
it really underlines that great investing is so often about seeing what other people are missing, or maybe what the standard numbers are obscuring.
Precisely.
So maybe a final thought for our listeners. The next time you're analyzing a tech company, especially one that mentions R&D grants or tax credits, maybe pause and ask yourself that core question from the source material we looked at. What would this balance sheet actually look like if they had to fund all their development internally with no government help?
That's the key question.
Because the answer might just reveal a significant hidden asset you hadn't seen. Or perhaps a critical dependency risk that changes your whole view of the company.
Well said. It forces you to look past the accounting reality to the economic substance underneath.